Hey guys, Boris, welcome to COM Dollar Technicals for August 29, September 2nd, 2016. Well, the interesting story in the COM Dollars basically is sort of the anti-yield trade, or the pro-dollar trade did a major reversal in the Aussie, the Kiwi, and dollar CAD had actually a big move to the upside, both on the failure of the oil prices and, of course, the pro-dollar moves. All of this is really being driven now very much by interest rate differentials. Remember, Aussie and the Kiwi were very strong premiums to the dollar because of their yield strength to the dollar. They're obviously much higher yielding currencies than the dollar. But now, if the expectation is that the Fed is going to hike, and perhaps not even once but twice, in other words, if there's 50 basis points possible into the U.S. yield curve, the rate differential between the Aussie and the Kiwi becomes much more compressed, much less interesting, and creates, I think, a much greater profit-taking potential flow out of those two currencies, just as you had this massive speculative flow into these two currencies on the assumption that, hey, nothing is going to happen in the U.S., therefore, we want to park all of our yield cash into Aussie and the Kiwi. There may be massive outflow out of those two, just basically based upon the Fed decision. So it's really all yield driven. The 10-year on the U.S. went to 163.7. It was trading as low as 153.7 front of the week. So we had 10 basis points on a 10-year. The 2-year on the U.S. had a nice big move up to 81 basis points. All of this is important because if you're really watching the Aussie, the Kiwi, the CAD is obviously its own story with the oil situation. It's really all about yields, and not necessarily absolute yields, but it's the relative yields. It's the yield differential between the Australian dollar, the Australian 10-year bonds and U.S. 10-year bonds, the Kiwi 10-year bonds, U.S. 10-year bonds, and most importantly, really, when you're talking about currencies, it's the 2 years against the 2 years. That seems to be the sweet spot of where the market is looking for. So when you look at those differentials, as those differentials start to compress, the whole story changes and profit-taking takes place in the Aussie and the Kiwi. As far as data this week, we don't have that much on the CAL. We have Australian private capital expenditures, retail sales. All of the sort of major central bank stuff comes out next week. We have the RBA decision, of course, next week. Doubtful they're gonna pull the trigger on a further rate cut. So that might be mildly Aussie positive. But again, at this point, it's not so much about what the Australians do. It's really what about the Americans do. And because the focus will be strictly on the Americans, there could be potential more for profit-taking going on in all the cross pairs. So let's just take a look at the COM dollars and where the resistance support lies this week. 76.50 to the upside now. 75 is the near-term support. It really could probably go down all the way down to 74s in the Aussie. Dollar CAD had a big reversal, and actually the chart looks quite good because again, it's one of those kind of big breakouts. In fact, it's a bigger breakout than dollar yen. So in some ways, if you're a pro-dollar trader, the dollar CAD to me is kind of again right back to being the poster child for buying dollars against the currency on any kind of a dip. We'll take a look at that in just 1 second. So 31 to the upside, 28 to the support side, and Kiwi dollar had a major turn, of course. Triple top, quadruple top at 73.50. Support now lies at around 7,100. Let's take a look at the charts and see how everything lines up. So first, let's start with the Aussie. So Aussie, big turn. Aussie also, what's interesting here technically is this preponderance of low highs, a failure, really sort of a big objective failure to rally here in the Aussie. 77.50 was the resist here that off of which has failed. We ended up on the lows of the day. Again, a pretty negative move. Suggests that we certainly can take out the 75.50s. Suggests certainly 7,500 is going to be in view of the market here front of the week, and I think possibly even 74.50 before the NFPs, as that's the big support level here in the Aussie that against which I think you're going to find some potential buyers. But certainly failure of lower highs, ending on the lows of the day. All of this suggests further continuation here in the Aussie, and I would definitely be not surprised to see 7,500 by the time Asia sessions sort of ends trading. And even pretty heavy dealing on the Sydney Open to try to sell this below the 7,500. So I like this on any kind of a bounce. Certainly any kind of a bounce over the 76s, I'd like to establish shorts here because I think there's potential here to move us at very minimum to 7,500 and possibly to test the 74.50 as the week progresses ahead of the non-farm payrolls. Dollar CAD is the really strong pro-dollar trade here. Not only because you had this massive reversal candle that's very bullish, but because the lows weren't tested, right? If you look at dollar CAD, it's something that I've been talking about continuously until I'm sure you guys are all, ready to put your head through the wall out of the boredom of my point. But it's a point very much worth trading, because if you stick to this point, you really have not been wrong. The idea was that dollar CAD was the best buy to dip trade against the dollar continuously since effectively May, because we have not, and this is the critical thing, broken the lows. Every low has been higher, right? So higher lows suggests that the uptrend remains in place. It's been very difficult. You certainly don't want to chase. You don't want to. The thing with dollar CAD is going to be you really don't want to buy the highs, because it's just very, very tough. But buying at the lower end of the ranges, even over here, any kind of 12, 29.50, 29.60 entry here on any kind of a retrace, probably a very decent entry here against certainly. Let me just take a look at this. What is the lows here? It's the 20. Is this 20? No, 28.30 is sort of the the lows from Friday. I think 2,800 is kind of a reasonable. That's the stop, against which you can operate. That gives you plenty of room for potential upside. Certainly, 3,100 is very much in view pre-NFPs. We have Canadian GDP as probably the only major event. We don't have Canadian labor until the week after. So this is one of those months where U.S. labor, Canadian labor actually are not on the same day. So it should be interesting to see. Let me just see what the Canadian GDP expectation is here. The numbers were, looking for actually a big bounce here. They're looking for 0.5 against negative 0.6. Probably could see certainly a little bit of a payback in Canadian GDP, but if we have a failure of a bounce in the Canadian GDP, that will only add to the woes of dollar Canada. The ultimate thing about dollar Canada is, though, again, it's the yield story. It's the fact that U.S. yields are starting to move up. That makes the U.S. dollar much more attractive than the Canadian dollar, and we certainly have the potential here, just on pro-dollar trade, to move ourselves through the 31s ahead of the non-farm payrolls. Now, the last thing here is the Kiwi dollar, which had, again, blew out through the new highs and then just whipped everybody out and took them down to end on the lows. Generally, very, very negative technical structure, right? You sort of test the highs, come back to the lows. Certainly seems like it's possible. I mean, 7,200 is the near-term view for the Kiwi. The more longer-term target, I think, is 7,100 for pre-NFPs for the Kiwi. The one thing that sort of makes the Kiwi less vulnerable to selling is the fact that the yield on the Kiwi dollar remains relatively strong, and the fact that the RBNZ did not really provide a super bearish message to the market. That they really sort of said there's only about maybe 25 to maximum 50 basis points worth of cuts. If, let's say, there's only 25 basis points worth of cuts in the Kiwi will suffer the least, because the yield differential on the Kiwi against the dollar will still be the richest premium in the industrialized world. So in many ways, the Kiwi here could be a relative strength trade, and it could actually, this brings us to our ideas for the crosses next week, that the Kiwi CAD, something we had looked at in the past, could be a potential trade next week as a yield differential trade, just as we looked at the Euro Pound as well. So for now, though, very, very little data on the Kiwi side. It's really a pro-dollar trade. Yes, we're going to probably test the 7,200. Beyond that, I think it's an open question as to how much more they can push it to the downside. Certainly, technically, a very, very big top-out failure here, but it's one of those kind of things that could be very, very choppy. Kiwi, to me, is an interesting sell against the trend trade. You certainly probably could feel very comfortable establishing positions at around 70 to 300 if it pops back up over there. But all of that is really contingent. Remember, the Kiwi trade is very much contingent on Fed raising rates, because Fed not raising rates makes Kiwi the shining star of the yield universe, and therefore tread here lightly. That's, I guess, my point is, I think Kiwi, of all the anti-dollar trades, is the least vulnerable to a decline, and therefore should be cautious in trying to trade this to the short side. And in fact, there are better shorts both in the Aussie and certainly in the dollar CAD, in my opinion, against the dollar than there are in the Kiwi. So be watching all of that very, very carefully. As I said, the big levels in the Aussie, we're going to try and probably test 7,500, 7,550, 7,500, and test the 7,450 ahead of the NFPs. With dollar CAD, it's a move all the way up to 130, 100, especially if oil prices weaken up a little bit. And with the Kiwi, it's tread water lightly because of the fact that the yield is still a very, very strong barrier against trying to short this too strongly. But still, it is a sell the rally trade in the Kiwi, especially if you can get into the 73s because of all of this congestion that we see here technically, and of course the assumption that yes, the Fed is going to finally pull the trigger. Wish you guys the best of luck, the best trading. Boris Schlossberg, over and out.